Okay, good afternoon, everyone. Thanks so much for joining us today. We've got another action-packed panel. Today's topic, reading of the cards, reflection and evolution of the single-family rental investment industry. So today, we've got an outstanding panel of experts. We're really going to be doing two things today, folks. We're going to take a poll of where we are in today's marketplace, and we're going to try and look ahead through our crystal ball to where we think we're going in 2022. And as always, we encourage your questions. So there will be a question tab on the top right hand of your webinar page today. All throughout today's presentation, put in your questions. We'll get to them at the end. And with that, we're going to get started with introductions. So first, Michael Finch from SFRhub Advisors. Mike, as always, great to see you from sunny Arizona.
Yeah, likewise, and appreciate you moderating, Jeff. You always do an amazing job, and thanks everybody else for joining in on the line. As Jeff said, Michael Finch here, SFRhub Advisors, SFRhub.com, and SFR Capital Management. We do a lot of things in the space. From the commercial brokerage end of working with buyers and sellers in the SFR and build for rent space to consulting with builders and developers and aggregating homes in a capital management platform as well. So excited to be here to join all of you guys and talk through what's happening in the industry and hopefully answer some of the participants' questions that come down the road. Thank you.
Yeah, appreciate it, Michael. And next up, we have Troy Evans from Marketplace Homes. Troy, good to see you.
Good to see you too, Jeff. A little bit about me. I oversee our property management division for small and mid-size investors. Marketplace Homes, sort of like what Michael was saying, we do a lot of different things here from new construction brokerage to national brokerage for existing assets. All the way to about 5,200 homes that we manage for both mid-size and institutional investors. So very excited to be here. Going to focus a little bit more on the operation side of things. Hope to give something to this and get something out of it.
Appreciate it, Troy. Thanks so much. Next up, Lee Rogers from Real Protect. Lee, as always, good to see you, my friend.
Great to see you too, Jeff. I appreciate it, and thanks to SVN for putting this together. And we're very, as always, honored to participate. And I am like Jeff mentioned, I'm Lee Rogers. I'm the president of Real Protect. We are a national insurance brokerage firm that specializes in working with real estate investors, and we work with investors really all over the world and insure properties in all 50 states. We work with a number of lenders, a number of marketplaces, and really just real estate investors all over the country to provide insurance and risk management. And again, appreciate being a part of the group and look forward to the discussion today.
Thanks so much, Lee. And finally, Scott Saunders from Asset Preservation, Inc. Scott, welcome aboard.
Hey, thank you, Jeff. Great to be with everybody. We're a qualified intermediary, so I'll be touching upon what's happening in the 1031 exchange industry, as well as giving some insights on some potential changes that may be happening or at least been proposed. So just want to thank SVN for putting this on. And Jeff, great to have you moderating again. This is always a real fun panel presentation to be involved with.
Thanks so much, Scott. Appreciate it. And finally, I am Jeffrey Tesh. I'm CEO of RCN Capital. We are a nationwide lender in all things investment properties with a special emphasis on single family rental aggregation loans. So we focus typically on folks that are building small portfolios, mid-size, and the larger portfolios as well, really from coast to coast, providing the debt that they need to build their assets. We started our company in 2010, providing capital to investors who are buying, fixing, and selling. We still have traditional bridge loans as well. We've really transitioned to an asset aggregation model, providing the debt to investors who are looking to create generational wealth by aggregating single-family homes across the nation. So great to be with you today and great to be moderating the panel. So let's get right into it. The geography across the United States in 2021 has been one of rapid price appreciation, really from coast to coast. But investors, it seems, are finding ways today to find pockets of maybe appreciation that's still got a runway to go. What I want to do for the first few minutes today is really talk about the different MSAs that are across the United States where we're seeing opportunities for investors to build out their portfolios and hopefully, once again, create that generational wealth that I just spoke about. And Michael, I'm going to start with you. The SVN SFRhub footprint is nationwide. So let's jump right into it. What are you seeing across the U.S. For those specific MSAs?
Yeah, I mean, to your point, it has been, hard to believe some of the price appreciation that we're seeing, and what's happened in, markets like Phoenix and Austin and, the Dallas Fort Worth area. I mean, just some of the biggest jumps we've seen, but rent is holding up with a lot of those markets as well. And the guys that are boots on the ground and digging and finding deals, you can find opportunity there. And there doesn't seem to be any shortage of job growth and in migration, a lot of these markets. So it bodes well for the price and rent growth appreciation. And then, we're seeing a number of markets, like some of the MSAs in Alabama that are performing very, very well for, investors looking for, a little more affordability and still good yields. The Triad area in North Carolina, great market, in Raleigh, Durham, with a lot of the job growth that's happening there. We're seeing some pretty exciting things in like the Chattanooga and Knoxville markets, where investors are finding good yields. Chattanooga's got that big Volkswagen plant there that's driving jobs. So, there are opportunities, kind of abounding. It seems almost every major MSA and secondary MSA is doing pretty well these days, and the savvy investors that are out there looking, it's arguable talking to a lot of the investors that that are a little self-deprecating, and they'll say, hey, I look smart no matter what I'm doing right now. And so sometimes there's a little, when you start hearing that, maybe be a little cautious and start sharpening the pencil more. But it has been a good wild ride for everybody in the SFR space for the last really 20 months after the fear of COVID sort of catapulted the hedge against the rest of the market in the SFR space.
No, that's really well said. And it's interesting, right? Like when customers make statements like, no matter what I do, I look smart. As a lender, right? Like at our RCN, we really appreciate the value of investors that have taken the time to look at the values and think about where they're going to be, not only 12 months, 36 months, 60 months down the road. And it really does make a difference. I mean, let's face it, last month, the data that came out, 19.1% year over year appreciation in the average single family home. And as an investor, especially the investors on the call today, right, you look really good because you're feeling like, you know what, that investment I made, it really worked out. We certainly don't expect that type of appreciation to continue forward, but we also don't expect to be going the other direction. So I'm going to pivot off of that question, but Troy, when you're working with your customers and they're looking at justifying the rents and how all that comes together to get that cap rate that they need, focusing again on MSAs, where are we seeing the value? Where are there opportunities that might still be uncovered?
Yeah, I mean, to piggyback off of what Michael was saying, areas like Phoenix, Atlanta, parts of Tampa and Jacksonville, where they're extremely well known for both mid-sized and institutional groups, the rents are keeping up with the appreciation in price, right? The cap rates are staying pretty consistent. You're not getting priced out from a return perspective. But what's been interesting in the market that maybe not MSA type, but state, has been Alabama. I mean, for us, we've been seeing this become a big winner by both individuals who are partnering with other people, out in California to maybe raise some money, 50, 100 million bucks to go buy some stuff. Birmingham, Montgomery, to build for rent, also in Montgomery being an extremely profitable route, because build and purchase costs are still moderately low, but the need for rentals are still there. And we've seen a asset class shift from more B- properties to more A in those markets too. So focusing on what would be considered more secondary markets, again, like Michael had said, seems to be a good route as individual investors and mid-sized groups are getting priced out of these larger markets like Atlanta. They're getting bid out. Focusing on Columbia, South Carolina, Round Rock, Arkansas, areas like that, where we've been seeing days on markets be low, rent rates at renewals and refills going up. It's been very successful for I'll say the little guy, even though they may not be so little at the end of the day.
So I'm going to make a comment on what we've seen at RCN, and then I'd like a follow-up, Troy. So one of our products that we use is obviously rehab and then coming together and getting stabilized debt. So they're bringing homes up to par. You mentioned a transfer of interest from that, C+, B- into a higher level aggregation model from a quality standpoint. Is that across MSAs, or has it been in specific geographic areas?
It's been definitely in specific geographic areas, and I'll add an asterisk to this. We have been seeing a lot of individuals who are going to what would be considered Class A homes, but focusing on maybe those have been owned by individual homeowners for 30 plus years, and they're still in good areas. You add $20,000, $30,000 to it to get that stabilized debt, get them rented up in just the same way. So no, I want to say that's everywhere where we're seeing that shift, because a lot of these markets we have been Class A, but in a lot of areas, Metro Detroit, like I said, Birmingham, parts of Florida, Columbia, South Carolina, and these areas where we're from what we've seen, were Class B, lower rent, more cash flow type deals, being more appreciation based.
Yeah, that's super interesting. Certainly a trend that we've seen on our side as well. Now, Scott, my guess is being the go-between, right, for the intermediary, you're seeing a shift potentially, and I don't want to put words in your mouth here, but potentially from coastal investors looking to different MSAs to maybe find those uncovered gems, whether it be aggregation of small, mid-size, or larger portfolios. Sticking with that MSA theme, what are you seeing?
Yeah, you're not putting words in my mouth. That trend has been accelerating over the past year to two, where we've seen people coming out of, let's say, the coast, coming out of the California, Oregon, Washington markets, where they've had tremendous appreciation. And what they're doing is they're redeploying their capital, and they're going into markets, some of the ones that have already been mentioned, but we're seeing St. Louis, Missouri, Memphis, and they're scooping up now 10 smaller replacement properties. So you can come out of $1 million single family rental and you can get 10 in one fell swoop. If you come out of 2 or 3, now you're picking up 20 or 30 assets. So those are some of the markets we're seeing. And, frankly, because of the internet making property management easier, and, Michael knows this well at SVN, SFRhub, it's getting easier and easier to manage properties remotely. And so you're starting to see investors that were familiar with staying in their local marketplace getting much more comfortable doing a 1031 and going into markets in Tennessee or Florida or Texas and taking advantage of all that growth. And they're blown away with some of the returns, right? When you come out of a market like California and you go into a Midwest market, the returns are so much more. The cash flow is so much more. So we've definitely been seeing that trend all year long. And, the biggest challenge, frankly, is trying to find replacement property, right? Trying to find the assets in that short 45-day identification window. That's the biggest challenge.
Yeah,
So Michael, I was going to shoot to you. I would think, right, like your advisory, this has got to be a real big opportunity. Those coastal investors coming to you saying, I've got to deploy this cash, help.
I'm sorry. I think I cut you off there, Jeff, when you were first talking.
Yeah, no, I was going to throw it back to you because I would think your advisory services for these coastal investors who have cash to deploy with these large sales are looking to these different MSAs, and the opportunities abound.
Yeah, they really do. And case in point, and this is unique, because we try to be very collaborative with outside brokers as well. We're working with an agent out of Orlando who has a buyer that lives in the mountains of California that has a 1031 that we're now negotiating an offer on a 225 home package in Louisville. So you've got it, zigzagging all over the country. And he's, I guess he owns some mobile home parks in California, but he really likes this asset. And due to Scott's point of utilizing technology and guys like Marketplace Homes to, be boots on the ground everywhere, it gives them the opportunity to seek high yield investments. And this Louisville deal, it's a Section 8, deal, all Section 8 homes. So you got guaranteed income. The actual cap rate is north of a 7.5. I mean, that's very hard to find these days. So yeah, it's a huge advantage especially for those groups on the coast that are trading out of very low cap rate yields, looking for higher yields and higher cap rates, moving inland.
Yeah, it just makes a ton of sense. I know for RCN, what we've seen is a real shift from mom and pop management to using more sophisticated management. And as a lender, right, we want folks to become more sophisticated, using Marketplace Homes to help manage their portfolios. That's how you were able to scale and really take your business to the next level. And, Lee, just to wrap up this MSA conversation and where we're seeing opportunities today, my guess is on the insurance end of things, you're seeing a big diversion of what you used to see compared to today, and some of those opportunities that investors are uncovering.
Yeah, absolutely. And a lot of the MSAs that were mentioned, are areas where we have a lot of properties insured, and kind of to the point as well of diversifying and being able to own properties outside of your geographic location to diversify where you own properties. That also can help with your insurance as well, because you're spreading your risk, right? You are eliminating some of the concentration of risk. And that's one of the big things as we get into BFR, build for rent, where insurers have a little bit of pause because you've got a lot of roofs a lot of the time within a concentrated area. So one big storm could come through. And the beauty of scattered site single family is that you really have a little bit of spread of risk. And so some of these areas like Phoenix, where you have not a lot of natural disasters that occur, are great areas from an insurance perspective. There are, let's just use a recent example, Hurricane Ida that came through a couple of weeks ago. Obviously, direct hit in the Louisiana, New Orleans area, came up through Mississippi, and then caused a secondary event in the Northeast with some flooding, which most folks don't insure themselves for flooding unless a lender is going to require that they have the coverage. What I would say from that too, and this may be a little tough to say, but there's probably going to be some opportunity for some investors in areas where they can go in, They have the ability to go in and rehab houses and pick up properties that investors have just gotten fed up with in certain areas because they're tired of dealing with natural disasters. We deal with a lot of hail across Texas and Oklahoma. We deal with every year for 6 months almost. We're dealing with named windstorms coming up through the Gulf or Florida or through the Northeast. So in those areas, there's opportunity to find some buying opportunities. But again, from an insurance perspective, there's in every single MSA, there's something that you need to be aware of, that just really, when you're thinking about investing in different areas, think about what those hazards could be in that area.
Yeah, no, that's really well said, and a great transition to what I want to speak about next, which is opportunities to find inventory. And certainly one of the areas that our investors at RCN are talking about is the idea that the forbearance is going to be coming to an end for homeowners that took advantage of that. And there may be some inventory coming into the marketplace through foreclosures. Also, the eviction moratorium being lifted in many of the states across the US, and the opportunities that presents itself. Lee, you mentioned, the terrible tragedy of floods and hurricanes and things like that. On the other side of it, we had the pandemic and the outcome from what's going to happen from that. And, Troy, I'll throw it to you first off. I would think some of your customers are discussing the opportunities that are happening from the eviction moratorium and the foreclosure potential that could be coming from the forbearance being lifted. What are you hearing, and what are some of your thoughts?
Yeah, I hear the idea of potential foreclosures come up all the time. I'm not as well versed in how that will play out. Mainly, as you can tell, I don't have as much experience going through these more cyclical cycles of the real estate market as a lot of people. But things like short sales that are probably going to start coming up, and opportunities like that are obviously on the horizon. The big thing I hear, obviously being a property management company, is the eviction moratorium, which we were very happy as a company when we heard that we can start filing some of these evictions that needed to be processed as that got shut down. We honestly didn't have as many in the backlog as we thought coming into this, as rental help through the states has been increasing. We have a lot of people taking advantage of that. We're trying to get the information out to them as quickly as possible, coming up with plans, ideas, agreements with these residents. But on that same note, we've been taking these opportunities for somebody who may not be cut out to be a landlord, an individual owner who doesn't want to deal with it, to maybe find an investor who's willing to take on that risk of the eviction, hold and sit on it for a while, maybe get them a good deal on the acquisition side, and then they can buy an asset that may need to be turned, but as far as their discount goes on the purchase, it makes a pretty good deal. So we've been taking all these different bad scenarios and trying to find the best of it, and it's been a secret, well, not really secret, but a little acquisition channel for some of our investors who are getting a 10-15% discount on the asset, taking on the idea that they may be in eviction for 2 or 3 months, eating that hold cost, if there is one, and then doing any work that needs to be done on the turn and leasing it back up. So that's been an interesting opportunity for some of our homeowners who aren't really wanting to be in the landlord game.
Right, makes a ton of sense. And, Michael, I would think as folks are aggregating homes for portfolios, they're looking for the next great opportunity, right? And typically out of crisis or tragedy comes opportunity. What are you hearing from your aggregators out there today on the ability to be able to add homes to their portfolios?
And I mean, there's no doubt that there's a want of opportunity. We're not, from what we're seeing and what we're hearing, it doesn't seem like there's going to be any glut of foreclosed properties on the market. I mean, I'm sure. I mean, we were just talking about how basically every market has appraised across this country. So those that have had some challenges, I think, with not collecting rents, obviously that's being lifted. Some of that may be offset by the price appreciation they may have garnered during that time period, and the banks aren't super eager to take homes back either. So I don't think there's going to be, no doubt there will be some foreclosures, but I certainly don't think it's going to be a glut of opportunity when some of these foreclosed homes do hit the market, and I certainly think they're going to be, kind of in the class C and D markets. So for the investors that target those type of opportunities, I think there will be some, but I don't think it's going to be, well, it's certainly not going to be anything like the last recession, and I don't think it's going to be as as opportunistic as some might be hoping for.
So that's a great point, which is, many of the properties today that will potentially be foreclosed on will be in those class C and D marketplaces.
Mm-hmm.
And some of the data that we use here at RCN, as a lender, right? Like, the last thing we ever want to do is foreclose. Like, we're bad landlords. We don't want to be landlords. We just want to lend money. So a lot of the data that we look at RCN is how much true appreciation has occurred in single family homes across the United States, which translates to our investors having built up equity over X number of years.
Mm-hmm.
And just over the last calendar year, the number that we saw is almost $1.9 trillion in increased equity over where we started at the beginning of the pandemic. $1.9 trillion in increased equity, which that goes to exactly what you said, Michael, which is most homes are going to have equity. So even if they're put into a bind in foreclosure, they may really not ever make it all the way to foreclosure, because the homeowner is going to be able to sell out and actually walk away with some money.
Well, and I think Troy made a phenomenal point in that, and we all know that the C and D class homes don't appreciate as much as, A class product in core markets, but there's been appreciation across the country. I mean, that's, no one's arguing that. So yeah, if they're struggling, but they can still sell at a 10% discount to an investor, still get out ahead, or even, which, as we all know, is oftentimes being ahead. It's an opportunity to, take a little bit of a win, go do something else with it, or kind of wash your hands and take a sigh of relief that, you're not actually in trouble, and you can make it up on another opportunity, and gives that investor the opportunity to buy right, which is obviously what all investors are looking to do.
Yeah, without a doubt. Lee, from an insurance perspective, how does the forbearance, eviction, does that play in at all from an insurance perspective? Is there any information you can provide our investors on what things they should be thinking about?
Well, and it's interesting. We get a lot of claim submissions again, where folks will, the lending industry or folks in general will carry what's called loss of rental income coverage on their dwelling fire policy or their insurance policy for the rental dwelling. And that coverage is triggered when there is a physical property loss that occurs on the property, and the property is uninhabitable. It doesn't occur just because someone decides not to pay the rent. But what we do see a lot of the times is when somebody is being evicted from a home, that they like to vandalize it on the way out. And so having good property management in place, and that results in an insurance claim, but having good property management in place to make the eviction process as smooth as possible, making sure locks are changed and there's no access back to the property sometimes is very important. I would also say as well, for folks and investors that are interested in ensuring that loss of rental income from the perspective of the tenant not paying the rent, there are some newer products out in the market that I've seen that an investor can insure basically that non-payment of rent exposure that they may have. And I think a lot of property management companies will use that, or they'll use some form of a deposit guarantee coverage versus traditional insurance. Whereas most of the coverage that a borrower would buy, again, the loss of rental income is going to be surrounding an actual covered property insurance claim where the property is not inhabitable. But there are ways to also protect yourself otherwise.
That's interesting. And, I think that's a great point for investors on today's call, which is working with a firm such as yourself to really uncover what some of those protections that they may not, first off, they didn't even realize were available, but second off, making sure that they have backup for their backup other than just the traditional fire, et cetera, and the different scenarios that can play out as a landlord and how to work with those products to really protect themselves.
Yeah, and I think too, it depends on the size of investor you are. If you're the mom and pop that's traditional in the market that's got one or two properties, you might really want to consider some of those products. As you have more scale and are a larger investor, then spending there's a trade-off of dollars at some point. And at some point you can kind of outgrow that need, I do believe. But for smaller investors where they're really sensitive to 1 or 2 months of lost rental income, those alternative products definitely make sense. And it's something that everybody needs to discuss with their insurance agent of, like, what does my policy cover? Nobody needs insurance until they have a claim, right? I've never met a claimant that had too much insurance at the time of the claim, and it's a lot easier conversation to have as an insurance professional or as a real estate investor at the time of a claim when you've got more coverage than you needed. So trying to find that balance and really understanding your policies, I think, would be the best advice that I could give any real estate investor. And really, not just your policies, but what are your exposures? Because most folks think insurance, just buy a policy. Really understand what your risks are. If you're a real estate investor, you are an entity, you are a company, you have a risk management division. It may be yourself, but you really need to understand what those risks are and then how to transfer those risks. Most folks transfer it via insurance, but there are other ways to do it as well.
Yeah, it makes a ton of sense. And, Scott, one of the things kind of transitioning out of this foreclosure eviction topic, now that we're moving into the next phase of whatever the federal regulation looks like, when we're talking about federal regulations, there's been an awful lot of talk about 1031 exchanges and what the new normal may look like. From an investor standpoint, that could be opportunity. It could be also very, very scary. Walk us through where we are today and what is going to happen. Well, I shouldn't say what's going to happen. What you think might happen down the road.
That setup there. Well, first off, today, that appreciation you mentioned of that 19 to 20% year over year, it's fueling a tremendous amount of 1031 activity. I've been doing this since 1988. We have never been as busy as we are now. So just right off the bat, and just of what's happening right now, irrespective of legislation coming, the appreciation has put investors in a position where if they don't do an exchange, they may have made a lot of money on profit, but they're going to end up paying a significant portion of that out. So that's driving the 1031 activity. When we kind of look at the landscape of what's going on, with potential changes in tax law. So most people are aware that President Biden proposed capping 1031 exchanges at $500,000 per person. So $500,000 for an individual. If you're married, it'd be $500,000 per person. So it's $1 million. A cap on 1031 exchanges is a big concern for many in the real estate industry for a lot of reasons. Right now, we're starting to enter that time frame when tax legislation is going to start to get flushed out a little bit. The way a tax bill moves is it typically starts. So you've got the president that had this proposal, and I think we all know that's part of a larger spending program, about $3.5 trillion that they're going to move through a process called budget reconciliation, which means they've got to find pay-fors to pay for the new spending. They can't just say, hey, we want to have all this new spending without finding a way to offset that with pay-fors. And so there are a lot of things that are on the table. There's talk of tax increases, raising capital gain taxes for higher earners. So that has people today going, maybe I should do the exchange now if taxes are going to be going up starting January of next year. When we look at the legislation and kind of what's going on right now, things are getting very, very interesting. We're very close to being able to see the text of the tax bill. So President Biden proposed this in spring. Now the House Ways and Means Committee is working on their tax legislation. The Senate Finance Committee is. We've already seen some of the pay-fors, a paper on the Senate Finance Committee, and right now 1031 exchanges were not on the menu of the first kind of go around. But take that with kind of a grain of salt, but that's at the Senate Finance Committee. With the House Ways and Means, we're sitting here on September 8th, and we're expecting to see the actual text within the next couple of weeks. So we're literally a couple of weeks away from seeing what will happen there. It's a mixed bag, I'll be honest. There are some people that are fine capping 1031s. They feel like that is enough gain. It allows the small investor to still do exchanges. There are others that are moderates that are on that committee that are concerned. They realize that we've got this massive pandemic that really hurt a lot of sectors of the commercial industry, right? Hospitality, office, there are, shopping, retail. There are segments that are really facing a lot less demand. There are structural changes. Look at how we're doing this conference where so many of us were doing in-person meetings, and yet meetings have now evolved to more of a Zoom format. Things have changed fundamentally with the pandemic, right? It accelerated change, and now we've all adapted. There would be a big negative impact on the marketplace if 1031s are capped. And so there are people that are advocating for keeping 1031s as is. There's actually a letter that hit the Hill today with about 40 different organizations signing on. So everything from the National Association of Realtors to Realtors Roundtable to multifamily to farm and ranch organizations that are concerned about how this will affect farmers and ranchers. So it really is widespread around the country. We're very, very close to knowing what the text will be, and then I'll have a little bit more clarity. It is, I will tell you, if we do have 1031s capped in the text that comes out of the House Ways and Means, it'll be a little harder to try and strip it out, right? Once it's in the text, you have to make a really persuasive argument to say why it shouldn't be there, and then they've got a challenge to find some other way to pay for it. So if you're in the text of the bill, it then becomes a little bit more problematic because now you got to find a way to offset that tax revenue. So we're going to know within a matter of, I would say, about 2 weeks, we'll be able to see some initial text coming out of the committee.
Interesting. So you today are busier than ever, just straight up from the amount of appreciation that investors have enjoyed over the last 18 months.
Yeah, absolutely. The 1031 industry, frankly, we're struggling to just keep up with the activity. I know many of my peers are working 5 to 7 days a week, longer hours, just trying to process it. So absolutely, we've seen a huge uptick in activity. When I say significant, like business has doubled, to give you kind of perspective. So it's significant.
That's fantastic. And Michael, I would think that 1031 demand, and it's not just the ability to be able to use that tax advantage, it's the time frame, right? Like it's a limited amount. Actually, Michael, before I go to you, Scott, just one more time for our callers today, just go over what that time frame is so they understand.
Yeah,
oh, you're
simply,
on mute,
when you close on a okay, back there. Simply, when you close on a property, you have 45 calendar days to identify. And so they're calendar days. They'll go through weekends, they'll go through holidays. So there's really a very short time period, and there's no way after day 45 to identify after that point in time. So you've got that short fixed time window, what we call an identification period, to decide on what assets you're going to buy, be moving to get them under contract, and then you actually have to buy from that pool of assets. So it's very, particularly in today's market where inventory is tight, that's an area where people are struggling or finding things. And Michael, maybe you can speak to that as to kind of, how you solve some problems in that area for investors.
Yeah, well, I mean, the first point is, if we're working with a seller that's planning on 1031, we feel like his asset will move quickly, we want to help him get started on looking at what's coming up, and that way we can negotiate between the seller who's going to be a buyer and who he's going to be buying from, so everybody is on the same page as agreeing to work within that time frame. That it doesn't always work out, but that's kind of a perfect world scenario. And then once that identification period has started, if you're an investor looking in the SFR space, I mean, SFRhub.com's got literally $1 billion on the market right now, and or coming to market. We can't keep up hardly with uploading the amount of traffic that's coming in. So there's a significant amount of inventory available, and we're working with a number. I mean, to your point, it's doubled. I mean, we're working with more 1031 buyers that that are using it as a down payment, that are just all cash and just looking to drop and buy a whole portfolio of homes. So it has been it's certainly busy out there, but it's a challenge sometimes to help them, and everybody gets a little nervous as that identification period is coming down to an end, and it can be very stressful. So the sooner that we can be talking to an investor that knows he's got a 1031 coming up, the better we can all sort of help calm those nerves and work to identify. Even if they're not looking in the SFR space and they want to branch out a little bit, just to open their horizons. I mean, being part of SVN is a huge platform with 2,000 commercial agents around the country, so we can introduce to the multifamily and the retail guys and the hospitality guys, if they want to see a few different options, just so that they're not feeling pigeonholed in one focus.
So I would think today, with the amount of activity in the 1031 exchange space, the pressure to identify those new products, Michael, is got to be tremendous. Because as Scott said, the clock is ticking. I mean, are there any tips that you can provide our listeners today that have entered that 1031 world on how they should handle themselves going down that road?
I would just say, reach out to myself or one of our team members ASAP. I mean, as soon as you're committing to doing a 1031, if it's not us, call a broker, any broker that you like working with and you trust. Call Scott. Make sure you understand your parameters. Start getting your ducks in a row, and utilize people that can help turn up deals, because you want to see everything. I mean, you want to see everything that you can as quickly as possible. I mean, no doubt about it. And if you're in the single family portfolio space, there is literally a tremendous amount of opportunity to buy, portfolios of assets right now. As I said, we can't keep up with. We are, but we are working hard to keep up with the amount of inventory that's coming in and going into escrow. But we've got a tremendous amount of opportunity out there right now.
Yeah, on the lending side, we have seen, and Scott, it doesn't surprise me what you're telling me today, right? Because we've seen it on our side, which is customers coming to us saying, hey, I'm taking this property or properties for X dollars, and I am moving up. In other words, I am building to that next level of portfolio. So yes, I am going to have this pot of money here, but I want to leverage that pot of money to move into that bigger portfolio that Michael might be selling on the platform, right? So I'm going to need leverage. And it's one of the reasons that we've seen so much activity in the 1031 exchange is because they're really looking to build that next level of that generational wealth using leverage, not just moving apples over to oranges, right? It's using new capital, infusing it into the deal. And of course, being a non-bank lender, the speed which we're able to operate the same way the speed you folks are able to operate is really, it makes all the difference in the world. It's exciting times for 1031, without a doubt. Troy, are you seeing some of your investors today adding into your portfolio of management, bringing more assets under your umbrella, whether it be through 1031 or otherwise? What are you seeing today for new aggregation of assets into your domain?
Yeah, I mean, we've definitely switched from the past 15 years being for the individual owner to being right now about 60% on the investor institutional side, 40% individual, probably 70, 30, 80, 20 by the end of next year. And 1031, for family offices, high net worth individuals, whatever that may be, has been significant where, it could even just be coming from the multifamily space, which is probably what a lot of people have been seeing. They send me a tape and they say, here you go, and can you manage it? Usually I say, yes, no problem, we're there. And if it's, a significant amount, several hundred properties, we have enough time to make sure all of our back end is set up to be able to do that. So a mix of changing asset classes, 1031 exchanges, new funds that people are raising to, test the waters a little bit, has been a bulk, probably 90% of my conversations over the past 6 months, and is increasing significantly.
Yeah, does not surprise me. This hour is flying along. I've got to move on to the hottest topic in single family, which is build for rent, right? We've all documented today the lack of inventory coast to coast. We've documented the slim pickings that we believe are coming down the road. So what's the next move? Ground up construction. And certainly as a lender, we have seen, certainly scattered site ground up. We've seen it for years. Now it's really ravenous. And of course, the more sophisticated build to rent communities. Lee, I'm going to start with you on this end because I think there's a lot of things that investors need to think about when they go down that road of vertical construction. And dipping their toe into that water is something that's exciting and opportunistic, but there's a lot to think about, Lee.
Yep, absolutely. A couple of points there. I'll start with replacement costs because one of the things we saw in the traditional single family rental market when there was inventory available was, and this is starting from 7, 8, 10 years ago, when folks were buying properties for 20, 30, 40 cents on the dollar, the replacement costs were well in excess of the market values. Now we've seen a big shift in that over the last several years where replacement cost and market values are coming more into line. And so we used to always have to discuss replacement cost / argue replacement cost with investors where they would say, well, I'm only buying it for 40,000. I don't want to insure it for 150. And so we try to come up with some value that satisfied the lender, the insurance company, and the investor. Well, in build for rent, we don't really have that because an investor knows what they just put into that property. It's hard to argue, well, I just spent $180,000 going vertical on this property and I only want to insure it for 90. We're not having that conversation anymore. So insurance companies are getting the premium for the exposure they've got out there now, which is a good thing overall, even though some folks would argue that it's a good thing overall long term. As an investor, though, as well, if you are going to build for rent, the first thing we want when you're thinking about risk management is who's actually building it. Are you, as the investor, acting as a general contractor, or are you hiring a general contractor? If you're hiring a general contractor, you want to make sure there's a good contract in place to transfer the risk, make sure that contractor is insured. If you are acting as your own general contractor, treat yourself just as you would a third party. Most of the time, you're not going to build the house in the same name you hold title in eventually. So you want to have that same contract between yourself and your entity that's actually building the house with the same risk transfer, because at the end of the day, if the claim related to contracting, we want to be able to point back to that contractor's insurance if at all possible, if it's a claim related to the actual construction of the property. So there are lots of different things that you can do as an investor, especially if you're building properties, to try to transfer that risk. But I would definitely always hire insured contractors that are hiring insured subcontractors. Again, I touched on it earlier, spread of risk. Some insurance companies won't love, if you're building an entire community of build for rent, they might not love the concentration of risk of maybe 80, 100 houses, 100 roofs that are right there, particularly in some markets like, say, Dallas or Oklahoma, or some, where one big hailstorm could wipe out a lot of roofs. And then as well as understand how your deductibles work. If you've got one policy that covers multiple locations, is that one hailstorm considered one occurrence, or is each property going to have a separate deductible per property? Because that can really impact your bottom line and your in your well-being as a going concern if you were to have lots of different deductibles across that property, across those different properties for one event. So those are kind of high points of what I would say.
Sure. So just a quick follow-up. You as the insurance vendor, right? Like, what are some of the low-hanging fruit mistakes that you see maybe novice investors or even more sophisticated investors make? And I'm sure you wish you could have had this conversation in advance and say, if you'd done it this way, it really would have made a difference.
It's that contract with the general contractor, and making sure that contractor is insured, and then listing you as the real estate investor, your entity, as an additional insured on their policy as well. Because if they cause a claim, you want their insurance to defend you. That's the biggest thing that I would say. And also, again, to understand the fact that if, hey, I'm actually acting as project manager or the general contractor, that they need a separate policy aside from the dwelling and the premises liability is provided by a lot of the policies that we sell. The actual operations that are going on, they want to make sure that those construction operations are covered.
Makes a ton of sense. And Troy, I'm going to go to you next, which, once again, your national footprint, built for rent. What are you seeing from investors, whether it be small aggregation built for rent, scattered site, to more sophisticated subdivisions? What are you seeing, and maybe some tips for investors on how they can get into this marketplace as well?
I think the biggest tip would be to, well, one, if you're coming into it, talk to a group that's fairly experienced on the brokerage side for deals like this, like SFRhub and SBN and those types of groups, because I think there is a lot of headway that they can help make in tandem with them. And we manage anything from scattered site, infill builds, where somebody's picking off, five lots in a community is going to be done through one of the builders. And building those up, scattered communities, one in Houston that we have about 5 communities with 20 to 30 in each one, to individual neighborhoods. We have a few in Atlanta, looking at North Carolina, Birmingham, Alabama, and areas like that. The biggest challenge for us is stabilization of the community in and of itself. Obviously, we have to find new ways to do that. Copy what the builders do to get them sold. Social media advertising, signage, and things to that nature is probably the biggest hurdle that differentiates these from the regular single-family rental portfolios. We just have to adapt from a marketing standpoint and a leasing standpoint.
So what advantage, right, especially from Marketplace Homes angle, what advantage do investors have going with the vertical model, and whether it be scattered site or larger subdivisions? What are those advantages that you would coach investors to think about?
From the advantage from what we see as a property management standpoint would be days on market. New construction is a shiny new toy, from a resident's perspective. So you're mitigating your risk there, as far as vacancy goes. And I also think that especially with the way that we're starting to trend to more of a build for rent cycle, your disposition opportunities become a little bit greater. You can take advantage of some of the appreciation in these markets as these builders are identifying them. You have all these people who have the capital that they want to acquire something, 5 years down the line. If you make sure that's operated correctly, you can keep it nice, still shiny, and just as well as when you built it. I think you open yourself up for a world of potentials to liquidate these off your books and reinvest, like you said, to the next stage of their portfolio. And I think that's one of the big bonuses that we just haven't seen play out because we haven't seen this 5 years down the line just yet.
Without a doubt. And Michael, I'm going to kick it to you. Certainly some great tips from Lee and Troy, but you're seeing it coast to coast, especially in the southern states. Build for rent. Walk us through it. How are investors winning today?
Yeah, there's a number of ways to win. Troy made a bunch of good points there to your initial question. I mean, you're going to typically have higher appreciation. You're going to have no CapEx, at all for a few years, at least. I think the average that's been quoted out there is usually 5 to 7 years. You're going to have pride of ownership type of tenants because there are families that are moving in for a longer tenure. So they're happy to be in a new home. So you're going to have good quality tenants. I think those, and then, you have good stable rents because most of these people are affluent and can afford to buy a home. They're just choosing not to in a lot of cases. And it's still actually a little bit cheaper to rent than own today, even with low interest rates. But all that being said, there's so many ways to do build for rent. Like, for example, we've got a public builder deal in Slidell, Louisiana right now. It's 38 homes. They're almost all contiguous down the street in one of the top 50 master plans of the country. I don't want to piggyback off the tragedy of the hurricane, but that it's out of the hurricane area. It's up high. People have been moving there because of that. So that's a great investment opportunity to buy new construction homes from a public builder. We see the fully contained subdivision, which today, 2 years ago, people were wondering, when a stabilized subdivision of build for rent product would be similar to multifamily cap rates. Well, you fast forward to today, and they're just about parallel. And I personally think those cap rates will compress beyond multifamily once people start recognizing the intrinsic value of the community that gets created, the tenure of the tenants, because it won't be as transitory. So I think there will be further value to add to those build for rents. Then you got scattered home, build for rents like you see a lot in areas of Alabama and Southwest Florida, which work tremendously well. You can buy brand new homes. You can still have a scattered portfolio if that's how you like to manage, or you've got these horizontal apartments that are much more cottage style, small 1s and 2s and a little bit of 3s. They really function like an apartment building, but they're still being considered build for rent because a lot of them are detached and giving people the ability to not have neighbors above and below them. So there's 1,000 ways to do it. I am happy to talk at length about build for rent, and I know we're running out of time, so I'll wrap it up. But yeah, feel free to reach out. All we do is talk about build for rent all day long.
Yeah, without a doubt, and certainly on the capital side, we've seen it from at first an infill perspective, and now larger developments. And at RCN, it's amazing how quickly the evolution happened, right? Like, it used to be in high demand areas. We were seeing that demand for infill, build for rent. And then in just really right before the pandemic only threw gasoline on the fire, that investors are like, we're all in on build for rent. And Scott, my guess is the 1031 exchange comes into play with that as well. Taking monies, identifying, and figure out a way to deploy that cash into new construction.
Absolutely. We're certainly seeing that trend on the 1031 space.
Yeah, without a doubt.
And Jeff, one quick point to what you just said. I mean, even before the pandemic, we were making an argument that build for rent and single family homes could be very successful as a whole community on the outer rings, 45 minutes out from a downtown, an hour out, because people still were willing to live further out. And now I mean, it's just been catalyzed with the work from home and everything going on. I mean, this is a whole new environment. So people now recognize it works infill and it works on the, the third rings. So it's just a great asset class.
Without a doubt. Well, folks, we have expended our hour quite quickly, as always. Listen, Scott, Mike, Troy, Lee, you guys have just really taken the information that you all have in your heads and downloaded it to our investor community. And that's what this webinar is all about. If anybody on today's call has any questions about any of the subject matter, please reach out to our experts. Any of us would be happy to provide you more information. Thank you so much and look forward to seeing you again next time. Thank you.
Thanks, everybody.
Thank you.
Thanks, everybody.